Welcome to ZoomOut, and here's our 2026 outlook. But before we get started, remember everything presented here is not investment advice. I'm biased, I have blind spots. This is for your entertainment only. In the first half of 2026, my theme is multiple tailwinds. I know 2026 started off with a bang, especially on the geopolitical stage, but digging down into the fundamentals, I see more green arrows than red. Starting with the hard data. Overall, inflation has remained sticky, but I think inflation will actually start to rise a little bit in the first half of 2026 as multiple effects and tariff effects start to really take hold. Unemployment for me looks like it's just kind of going sideways. The job market is not robust, but the shrinking of the labor pool with all the immigration activities will probably keep this in fairly healthy balance. Overall, the index indicators in the service industry and the manufacturing industries have remained fairly okay. They may start to pick up a little bit. Retail sales have remained actually fairly robust, with the top 10% of American wealthy carrying about 50% of the spending. I think that will continue as long as the stock market continues. Finally, the real estate market was really rather poor in 2025, but I think it's starting to bottom out. Not so much as recover and grow, but at least bottoming. The soft data, the sentiment, consumer sentiment is still rather poor. I think CEO sentiment has leveled out, and there are a little bit of hopeful attitudes towards mergers, acquisitions, perhaps some extra clarity on tariffs so they can move forward with their plans. We definitely are going to have some Trump stimulus coming in the first half, which is going to be very robust. The rest of the world likely also going to have some stimulus. And finally, I think for the dollar, we may have an up and down year, but starting off maybe a little bit weaker. And I think in the second half, we might actually get a stronger dollar. And now, drum roll, please. Here are my big crystal ball predictions for 2026. Let's go through these one at a time. Will there be a recession in 2026? An emphatic no. Short of a war, a pandemic, or a major natural disaster, we have three arrows of major stimulus coming for the US. First, the Fed has already restarted QE, which will provide liquidity to the financial system. Second, the Treasury will provide fiscal stimulus by borrowing more money, aka going deeper into budget deficit, that will provide liquidity in the real economy. And finally, Trump wants to win the midterm elections and will do political and geopolitical things to encourage a roaring US economy. If we avoid a shooting war, the US dollar should weaken, which should be a short-term stimulus for the US and the rest of the world. I stole this from Apollo's chief economist, Torsten Slok, but it outlines his 10 tailwinds in 2026. Again, less trade war uncertainty, a healthy stock market to keep consumer spending up, and the fiscal and tax stimulus from OB3, One Big Beautiful Bill, providing cash directly to Americans. On top of these, I suspect a reduction of tensions over Ukraine and the US-China trade war will be negotiated in 2026. Here's a quick snapshot of the expected Q4 2025 GDP, which is now a booming 5.3%. Overall, 2025's GDP was a healthy 2+%, and the average forecast for 2026 GDP is, again, well into the 2% range. During periods of Fed QE, we tend to get healthy risk-taking, which especially shows up in the financial markets. This time it's a little bit different in that interest rates are no longer at 0%. While adding Fed liquidity will be beneficial for financial markets, the spigot is, so far, expected to just keep the tub full but not overflowing. In the first half of 2026, Fed QE should be supportive of stocks, but we need to monitor if the second half of 2026 or 2027 will be as robust. Geek out slide number 1. Here's a pie chart splitting up the size of central bank balance sheets globally. The Fed and the People's Bank of China represent the two most impactful central banks in the world. As the US dollar is still the reserve currency of the world, the Fed's impact on the financial markets is immense, while China's dominance in global trade makes their central bank policy more impactful on trading economies. Fed QE, or quantitative easing, was the primary tool used to combat the 2008 financial crisis. Essentially, the Fed printed up money out of thin air and used it to buy US treasuries, essentially lending a lot of money to the US government to keep the lights on. When the Fed set interest rates to zero, this was a cost-effective way to give the economy time to recover. Today, however, interest rates are higher and the US borrowing needs are much, much higher. Trump 2.0 was supposed to cut government spending, but Doge cuts made hardly a dent. Now, in 2026, Trump is talking about doubling US military spending, practically increasing US Treasury borrowing needs. He hopes tariffs and a robust economy will help pay for the extra spending, but realistically, I highly doubt the timing will sync. Regardless, in the short term, higher treasury spending is a positive for the real economy. For example, Trump buys more military, who get paid and then spend on their vendors and employees, who then spend on vacations and bigger TVs. Overall, liquidity matters. Tracking the ups and downs of the liquidity cycle has been a far better predictor of US stocks than any fundamental approach to investing. Of note, you see that the lines have diverged in the second half of 2025. With the restart of Fed QE in December, the dark red line will rise. The burning question is, will it continue to rise through 2026, or will the orange line reflecting the stock market start to fall? I'll be watching vigilantly. Meanwhile, the real economy has remained okay, but it looks like economic momentum has bottomed and may be recovering a bit. We usually use ISM indicators to assess real economic activity. The US no longer makes as much stuff as we used to, but the US service economy is the primary engine of US employment and economic activity. Here, we see employment and new order activities rising since the summer of 2025. Now, talking about Trump's stimulus, it has remained headline news that Trump wants interest rates down. He's tried to get rid of Fed Chair Powell without success so far, but he need not wait much longer as he gets to appoint a new Fed chair in May of this year. Whomever he appoints will be biased towards cutting interest rates further. Right now, it's a battle between the two Kevins, Kevin Hassett and Kevin Warsh. Just last week, the betting markets thought Hassett would be the next chair, but recently it's flipped to Warsh. Personally, I think Hassett is seen as too vocal and too much a Trump puppet for the markets to like. More importantly, the chair does not decide interest rates alone. The voting members on the Fed board do. As much as Trump would want a puppet running the Fed, Warsh, a former Fed voting governor, may be more effective and accepted in persuading his colleagues. To emphasize my point, the Fed quietly reappointed 11 Fed governors to extend beyond Trump's term. Essentially, they have ensured that qualified, experienced people will vote on Fed policy, even if the Fed chair is politically motivated. Overall, it's not a given that interest rates will be cut as soon as a new chair is appointed, even though the market is expecting more cuts in 2026. Globally, central banks have stopped cutting interest rates, with only the US and the UK forecast to cut in 2026. What does this tell you? Inflation is not dead globally. The geopolitical chessboard has been reshuffled. Defense spending and national security will require fiscal stimulus, and tariffs and trade wars require investments and reindustrialization in the West. Truth be told, it seems silly to cut U.S. interest rates when we are far, far from a recession and the U.S. economy looks relatively healthy. If we cut further, the U.S. economy may run too hot, thus creating more inflation and triggering a need to raise interest rates. This would counter the true reason for the U.S. to cut, to manage our growing mountain of U.S. debt and annual interest payments. Instead of spending $1 trillion a year paying interest, can you imagine spending that money on improving our power grid, schools, or the healthcare system? Trump's tariff war was shock and awe to the global order. At the time, I thought it would scare away foreign capital, but the reality is that was only temporary. Foreign demand for U.S. financial assets was higher in 2025 across all assets. When the facts change, I change my mind. The new global order has the U.S. reasserting itself as the only superpower. The might of the U.S. dollar and the U.S. military give credence to investor capital going to where it's safest and most likely to be profitable. The US remains one of the most attractive places to invest in the world. Moving on to number 2, will the AI bubble burst in 2026? I don't believe so. When bubbles burst, the offending sector tends to drop about 80%, and I simply can't see that happening. Unlike the internet bubble, the leading AI companies are highly profitable, cash flow rich, and have balance sheets that even the biggest banks are envious of. The Magnificent Seven are at no risk of going bankrupt, so I can't imagine an 80% drop. However, they could reprice to more reasonable expectations. Definitely, a 20% correction is completely possible as revenues from AI sales is nowhere near the $1 trillion that the Mag 7 are spending to build out the AI infrastructure into 2028. Overall, I think the AI first order, the companies that are building out the core infrastructure of AI, is essentially done. We have detailed forecasts of all the spending that will be done over the next 3 years, which is massive, and there should be few surprises. I think the second and third order of AI adoption are the themes which still have upside potential. Companies that sell AI productivity and cost savings could surprise. In the third order, companies that use AI in unexpected and innovative ways are still coming. As with any truly great technology, human behavior will change with these new innovations. How we work, how we play, how we get around, how we interact with each other. AI will make knowledge abundant. AI robots will make labor abundant. Just think on that. This will change everything. To back my claim, here's a chart that maps out the Mag 7's impact on the stock market over the last few years. From about a 2/3 to 1/3 weighting, the magnificent weighting of S&P 500 returns has declined. The AI hype is now facing the reality of how to make returns on investments in AI infrastructure. Going forward, Mag 7 earnings may shrink as sales don't keep up with the massive costs. Rotation into other sectors seem to be picking up energy as investors take profit and move money into commodities and international markets. In the real economy, AI infrastructure spending has been a real boost to GDP, and the forecast of AI capex into 2028 will continue to support the real economy. No other country on the planet has the compute power nor nearly 1.5 trillion of investment into more compute power than the US. Now for question 3, is more deregulation coming? I think yes, primarily in the banking and crypto spaces, but also broadly in sectors that touch on national security and reindustrialization. Unfortunately, there are no good charts to help visualize this, but banks will be able to free up more capital for lending. Securities rules and stablecoin adoption will support digital tokenization of traditional finance, and I expect a busy 2026 for mergers and acquisitions with less pushback from the Department of Justice. On the flip side, Trump has become an interventionist and wants to enact executive order and price control on sectors that might influence voters in the midterm elections. Capping credit card APRs or buying $200 billion of mortgage securities distorts markets but are appealing to Americans. All politically savvy moves, but harmful in the long term if we believe in capitalism. We'll see how much pushback and how far Trump gets with these measures. But it may be enough to just look like he's trying to help the average Joe over the fat cat bankers. Now, the Donroe Doctrine, what it means and how it might impact the economy and markets. Donroe Doctrine is a play on words based off the Monroe Doctrine of 1823, which basically opposed any foreign interference in the Western Hemisphere. Trump Rubio have revived this foreign policy, and with the colonization of Venezuela, have completely reshuffled the geopolitical chessboard. Controlling the Western Hemisphere means control over abundant metals, energy, and a young demographic ready to move up the socio-economic ladder. And if the US can successfully kick out the Russians and the Chinese, the US will gain control of critical natural resources that China needs for survival. China's investments in Latin America could all become worthless as they have no ability to project power across the Pacific and protect their assets and allies. And now, with Iran teetering on the brink of civil war, US influence over Middle Eastern oil has increased as well. I believe US geopolitical power has doubled over the last month, which hopefully will result in more successful negotiations with China and Russia in the coming year. Looking at the nitty-gritty, here's a chart of oil reserves by country. Now granted, OPEC nations self-report these figures, but let's assume they still have significant quantities of oil. Just adding Venezuela to the US would dominate global oil markets. And with the current friendly relations between Trump and the Saudis, the US is in a power position to negotiate with China. Now, oil reserves are not the same as oil production. Currently, the US is the global leader in oil production. Venezuela, rich in oil reserves but poor in actual oil output, will take 5 years and tens of billions of dollars to ramp up production. But that doesn't matter in the long-term geopolitical thinking. What matters is that China does not own significant oil reserves and must import oil to keep the economy running. Yes, they have massive electricity production capability, and it's the world's leaders in alternative energy. But trucks and fighter jets and ships still run on carbon, and they wouldn't be able to fight a war for long if they could not receive these oil imports. And as a quick aside, the US is a world leader in natural gas production, with the cheapest natural gas on the planet. Since the Ukraine war and the destruction of the Nord Stream pipeline from Russia, the EU is now dependent on US liquid natural gas for their energy. Europe doesn't really have an alternative supplier at scale. The US's geopolitical power over the EU is significant, not just with energy, but also with their financial and physical support of NATO and the defense of Europe against Russia. Going back to Venezuela, their oil reserves are well explored, and US energy majors were deeply involved with oil exploration and production dating back 30 years. Their infrastructure has since fallen into disrepair, but is probably more advanced than even in Russia. Right now, Chevron is the only company with active and licensed operations in Venezuela, but Trump is trying to get all the US majors to jump in. This will take time and leave plenty of opportunity for continued social unrest to unfold within Venezuela. Having said that, the removal of Maduro won't make things worse, and there's hope that things could be better. Around Latin America, Maduro was definitely not well liked, and his removal was seen positively across most countries. As the US gets more involved in Latin American politics and economies, under the guise of fighting narco-terrorists and cartels, there is a scenario where American influence and protection could stabilize some countries and allow them to prosper. As an amateur geopolitical strategist, I would focus on Cuba, Panama, and Colombia. Cuba's close proximity and friendliness with Russia and China are national security threats that Trump wants removed. The US has cut money and oil to Cuba and intends to force Cuba to the negotiation table. Hopefully we can get to a peaceful agreement. Otherwise, I would imagine US support for civil war and regime change. Meanwhile, the Panama Canal is a strategic bottleneck that the US wants to control as well. Panama's government seems to lean towards the US, so I would expect further regulatory actions to remove Chinese money and influence. And despite Trump's rhetoric against Colombia's outgoing President Petro, a recent White House visit seems to have changed the mood. If Colombia could be brought into the US sphere, Chinese and Russian influence in the region will be greatly diminished. Now, moving over to Iran. Recent widespread protests have triggered security forces to forcibly quench protests, resulting in the death of thousands. Trump warned the Ayatollah not to execute people and told protesters that help is on the way. Strategically, the US would love to see the current regime fall, but an ensuing power vacuum would have geopolitical consequences that the US is not eager to get tied up in. Meanwhile, Iran is internally complex, with a broad array of ethnicities, values, and religions that make governance challenging. I do think Trump will provide quote-unquote help to support a rebellion with weapons, money, and intelligence. Ideally, the standing army will support the rebellion against the clerics and their security forces. But if the standing army does not get involved, the rebellion will likely peter out again. Regardless, Iran exports millions of barrels of oil and is a major supplier to China. China cannot afford prolonged unrest and uncertainty in Iran, while the US is more than happy to encourage it. This must definitely weigh on China's calculus and strategic planning. Of course, we also need to talk about Greenland. To start, I don't think Trump is serious about invading and taking Greenland, but his extreme rhetoric is useful in forcing the EU and NATO to consider how important US security is to their own security. It's not really about the natural resources in Greenland, but it has a lot to do with controlling shipping and enemy submarines in the Atlantic, the newly available and shorter shipping lanes through the Arctic, and for command and control with space. Ultimately, I think the US wants the freedom and right to build out Fortress Trump in Greenland, unencumbered and forever, and to have the EU help pay for it. The goal is to keep out Russian and Chinese naval power and protect and weaponize space and communication assets. Now, many have said, including China, that Trump's kidnapping of Maduro ignores international rule of law and thus frees China to do as it pleases when it comes to Taiwan and the South China Seas. On December 30th, pre-Venezuela, Chinese military exercises again practiced blockading Taiwan in an attempt to show the strength of China's military prowess. I think, though, that the US capability to sneak past Russian and Chinese defensive weapons in Venezuela, kill hundreds of Venezuelan soldiers, and grab Mr. and Mrs. Maduro in the middle of the night without any US casualties probably caused Russia and China many sleepless nights. With a US aircraft carrier group sitting outside Venezuela for months, the US attack was not a surprise. What was a surprise was, despite their vigilance, Venezuelan forces equipped with advanced Russian and Chinese detection and defense systems were utterly useless. Furthermore, neither China nor Russia had a response to losing their ally. China may do better in fighting a war near their coasts, but they are severely outgunned if the war were to expand globally. No, I think China is now less likely to move kinetically against Taiwan, especially since Trump wants a trade negotiation. As I've mentioned before, I have no illusion that Trump or the US care that Taiwan is a lovely democracy that needs to be defended at all costs. I think the secret deal will be, give us 5 years to force Taiwan Semiconductor to build factories in the US. Then, one China policy, Taiwan is all yours. As the Donroe Doctrine unfolds over the next decades, and yes, I do believe the next president, whether Republican or Democrat, will strategically maintain the doctrine, though they will differ in how they execute. I think that Latin America, India, and Turkey will receive outsized attention and opportunity, and will rise in geopolitical and economic power, as investors looking outside the US for opportunities seems to have a long-term tailwind. Now, with every action, there is a reaction. From China's perspective, Trump has changed the geopolitical power dynamic, tilting it heavily in the US's favor. However, China is still a powerful country with a stranglehold on goods manufacturing, rare earths and magnets, green energy, and EVs and robots. For 2026, it would be wise not to escalate tensions with the US, so I suspect that China will be more motivated to achieve a trade agreement this year. This could also mean that China applies more pressure on Russia to negotiate a ceasefire in Ukraine. Ironically, this may cause tension between Xi and Putin. Remember that these neighboring nations have a long history of distrust and conflict. Meanwhile, China is stuck economically. Their self-inflicted real estate bubble bursting has trapped Chinese consumers into a hunker-down spending mode, and despite record-breaking exports in 2025, Chinese factories are just surviving against rising costs, thin margins, trade war headwinds, and aging demographics. In charts, China's exports boomed in 2025. Now, some question if these figures are accurate, which I can neither confirm nor deny. What is very interesting, however, is that trade with the US dropped 20%, while trade with the rest of the world accelerated. China is now the largest exporter of cars in the world, and their EVs are very popular in emerging countries. But let's not forget that many government-supported industries in China are subsidized and measured on market share, not on profitability. Indeed, China tends to overbuild capacity, compete on lower and lower prices, and end up killing profit for all participants. In short, booming exports does not necessarily mean booming profits. Kind of a similar chart, but what I want to highlight is that these are percentage change charts. I don't have the actual dollar figure values to give context, but for example, trade with Africa clearly boomed, but does that mean it went from $1 billion booming to 10 billion or 100 billion booming to 500 billion? Second, profit margins matter. Selling goods to lower per capita income nations won't produce high margins, so the shift away from the US consumer probably means Chinese factories are much less profitable than before. Now, since the pandemic, China's economy hasn't really recovered. Whether industrial production or retail sales, both have been weak due to weak demand and low profitability. To revive the Chinese economy, the government will have to step in with stimulus. The main question is, who do they want to support, the consumer or the factory owner? Now, in China, any extra money used to be invested in real estate, but when property prices collapsed, Chinese consumers were trapped in a depreciated asset with no one to sell it to. It's been about 5 years now, and there's signs that the worst is over. Not that real estate will recover from here, but at least it shouldn't get worse. If China could support consumers and encourage them to spend more, it could have broader economic positives. I think China will try to support consumers this year rather than support companies to build more factories. Now, going back to energy, which is foundational for a growing economy or a country at war, let's look at where and how much China gets of crude oil. Russia is China's largest single supplier, with pipelines and shadow tankers that keep Russian oil flowing. Saudi Arabia and Iraq, number 2 and number 3, and then we get a mishmash of Middle East and South American providers. Roughly, Russia supplies about 20%, the Saudis 14%, and the Iraqis about 11%, making up about 50% of China's total oil imports. The rest is a mix of suppliers from the Middle East, about 18%, South America, about 7%, and others, including Africa, about 17%. If you noticed in the chart below, Malaysia is a significant 13%. But the reality is, Malaysia doesn't produce much oil, but receives Iranian and Venezuelan oil and rebrands it Malaysian to avoid sanctions. So here's the rub. If the US wanted to actively restrict oil to China, they could cut off Iranian and Venezuelan oil easily and exert pressure on Saudis and other Middle Eastern oil as well. China's only reliable large supplier is Russia. When calculating geopolitical power, Sun Tzu would say that losing access to vital supplies is a very bad position. China, of course, is trying to diversify its suppliers of energy and other natural resources and metals, as well as open up new markets to sell Chinese goods. They've been extremely busy in Latin America and Africa, which is all fine, as long as the shipping lanes are safe and open. Chinese Navy, however, is unable to project power past the South China Seas. When you don't have nuclear-powered ships, you have to refuel, and you need an entire supply chain and assets to safely do so. Again, China's global trade and expansion hinges on US protection of shipping lanes, as the Chinese Navy is unable to provide this protection. Naturally, China likes to build inventory of critical metals and energy, for just in case. With renewed trade tensions with the US, they have been busy stocking up industrial metals and will likely continue to do so in the near future. As I mentioned previously, I don't think China would risk invading Taiwan right now. However, I do believe they will continue to flex their military muscles. If I were China and needed to reassert power over Taiwan but without triggering a full-blown shooting war, I would either continue doing blockades, but for a week or a month to disrupt global trade with Taiwan, or I might actually invade and take over Kinmen or Matsu Islands, both of which are tiny islands held by Taiwan, but which are just a few miles from China's coast. Taking these islands could be done in a day with minimal casualties, but it would be a statement action to the world. If you agree with the One China policy, hello UN, then you can't disagree with China using the Insurrection Act to quell unrest in our own island. For the rest of the world, it won't be worth fighting a war over a couple of tiny islands with about 150,000 people. Sadly, the greatest loss would likely be access to the delicious Kaoliang wine these islands produce. Now, about China stimulus. This is a great chart comparing US versus China liquidity cycles. The US cycle looks like it will peak this year, while China's cycle looks like it has bottomed and will begin rising. It's interesting that the US and China cycles were previously in sync, creating massive global impact and momentum. But when the cycles diverged after the COVID pandemic, we may see stronger Chinese stock markets in the near future. And now, US politics. This year's midterm elections seem important not just for the US, but the entire world. At risk is Trump's ability to push through and amplify policies that consolidate executive power and forcefully change geopolitical dynamics. I fully expect that with all the government stimulus and Trump's own version of political stimulus, the US economy will be okay to good by November. The stock market will again be a priority for Trump, as the wealth effect derived from roaring stocks can likely continue to fuel consumer spending. However, many of Trump's policies run the economy hot and thus will likely run inflation up. And this gets to the root of the affordability crisis in the US. The Americans in the lower leg of the K economy are still suffering, and this, along with other political hotspots like ICE and Venezuela, will, I believe, continue to trigger a backlash against Trump. Additionally, the fervent support that was MAGA is shaken by heavy US intervention abroad. MAGA may not go against Trump, but they may not be as motivated to go vote for a Trump acolyte. I think the House turns, not sure about the Senate, and we get a divided Congress. This will serve to gridlock more Trump policies and political appointments, leaving the US to coast along for several years as the consequences of earlier policies unfold. As this chart clearly shows, sadly, the top 10% of wealthy Americans drive 50% of consumer spending, while the bottom 80% is clearly spending less and less. This is not economically or politically sustainable. Trump promised to kill inflation and help Americans, but his policies have served to keep inflation sticky and will probably cause higher inflation. Special elections this year so far have been a resounding backlash against Trump, and despite what I expect to be a healthy economy and decent stock market, angry voters are the ones most motivated to vote. I don't see the causes of this anger being fixed before elections. With all these considerations, here are my investment themes for the first half of 2026. I expect healthy but not excessive U.S. liquidity for the first half of 2026, but with U.S. liquidity peaking and rolling over sometime in 2026. Broadly speaking, this is good for U.S. stocks, but we must be cautious into the second half of the year. The AI tech theme is still solid, but I think we rotate out of AI infrastructure into second and third order AI themes. Globally, no country on the planet is doing austerity and will likely push the political easy button and print more money. This global monetary debasement will keep momentum in gold and crypto assets. Meanwhile, U.S. deregulation will continue, opening new activity and opportunities in U.S. financials, industrials, and stablecoin. U.S. dollar weakness will, I think, continue in the first half, thus continuing outperformance in international and commodities. The Donroe Doctrine will continue to drive government spending on defense and the commodities needed for national security. Finally, I think there's a place to focus on income. Stocks will likely be volatile, but generally up in the first half of 2026. But for some portfolio stability, I think having some high dividend income from emerging market debt, mortgage debt, and actively managed options is wise to have in the portfolio. All right, that's all for now. Hope you've been entertained and moved to think. Thanks again for watching, and feel free to share this video and reach out to me with your thoughts and questions. Happy trading.